Today we're going to do study unit 2 and 3 in your study guides. And then next week, so last week we did study unit 1, right, which was financial analysis. And we did the first 10 questions in the assignment. The second 10 questions in the assignment are mergers. If you look in your study guide, mergers is something we only cover in study unit 6, right? So lecture 6 is when I'm going to get to mergers, because I'm going to spend 2 weeks looking at weighted average cost of capital. So lecture 6 is when I would get to mergers, but obviously I need to get there before, because your assignment is due the 29th. Have they moved it? I don't know. I don't know if they have. I've heard nothing. But what I'm going to do is I'm going to do mergers next week. I'm going to push it forward. I'm just going to do the theoretical aspects of mergers, and we're going to finish that assignment next week. So in case you start to panic during the week thinking that you have an assignment due. So next week is the 20, today is the 21st. So next week is, today is 20, next week is 27. I think your assignment's due 29. And it is multiple choice, so it's easy to submit. It's not like it's going to take you hours to put it together, right? So first 10 questions we did last week. Next 10 questions we'll do next week. And then next week we'll start with WAC, but we'll spend the bulk of the lesson doing those 10 questions and looking at mergers. So today we are going to do study unit 2 and 3, which is a smallish study unit. And really what we're talking about, or we're starting to talk about, and I said to you last week that this module is long-term. So we're starting to talk about financing in a business, financing of a business, isn't it, and in a business. So financing in a business typically starts with share capital. Yeah, it's the first form of finance in a business is share capital. Financing is the second decision. It's never the first decision that is made. The first decision is, what assets do I need? What assets do I want to buy? Which assets should I buy, isn't it? And the second decision is to then decide how you're going to finance those assets. And even if it's a brand new business, your first decision is, what business do I want to start, isn't it? What business do I want to start? What is it going to cost me to do that? And then the second decision is, where am I going to get the money? Yeah. So most businesses start off with share capital, which is the first kind of financing, but then at some stage branch out and get some kind of debt. Yeah. And there's a big discussion, you'll see it in your handout, about whether debt is a good thing or a bad thing. Yeah. Should we get debt? Shouldn't we get debt? Yeah. And there are really two schools of thought around this whole question about whether we should get debt or not. The first school of thought is the traditional school of thought. The traditional school of thought says, yes, of course we should get debt. Yeah, what the traditional school of thought says is debt is cheaper. Debt is tax deductible. Debt is something that provides leverage in our business. And this leverage in our business makes the return on equity increase. I can give my shareholders a bigger return on their money if I have debt. Yeah, how's it? So let's have a look at that. And I think it is something that I would have shown you in second year, or that you would have seen in second year. Here's a business that starts out with, let's say, 100,000 Rand of equity. And with that 100,000 Rand of equity, they buy 100,000 Rand of assets. Equity, and they buy assets. They make a return on those assets. Let's assume the return that they can make on those assets is a return of 20%, just for simplicity. So they make money. They make 20,000 Rand. And at that stage, all they have is equity, isn't it? So at that stage, all of that would go up here, and return on equity would also be 20%. Do you agree? Now the company goes out and borrows some money. They get some debt. And when they borrow that money, let's assume they borrow another 100,000 rand. And let's assume they borrow the money at 5%. Yeah? They now have 200,000 rand of capital. We call it capital in our business, debt plus equity. That capital, they invest in assets and they make a return. And do you agree that an asset that is bought with your own money or an asset that is bought with somebody else's money is the same asset? And you can get the same return from it, isn't it? So let's assume that they are still making a 20% return on assets because it's the same asset. And they now make 40,000 rand. This 40,000 rand now belongs to two people, isn't it? Belongs to the shareholder and it belongs to the bank who borrowed you money, who lent you money, who you borrowed money from. So now you have to pay them back. You're first going to pay the bank, isn't it? They want to be paid first. So you pay the bank, you have to pay the bank 12% on 100,000. And it leaves you with 28. Do you agree? Now the shareholder who was only getting 20,000 rand is getting 28,000 rand. He's now getting a return on equity of 28%. And look, he hasn't put any more money into the business. He hasn't put any more money into the business than what he had before. We haven't increased the return that we're making on the money he did put in, isn't it? Because we're still getting 20% on assets. But what we have is we have something called leverage. Leverage says that if we can borrow money cheaper than what we can get if we invest it, then we can make money, isn't it? I had a colleague when I first started articles. Geez, it was so long ago. His name was Michael, I think his name was. And his dad was a stockbroker. So he came in, of course, already at an advantage to some of us. His dad was a stockbroker. So he came in and he did this very interesting thing. He bought a car with a huge balloon payment. The rest of us bought our cars and wanted to pay them off in the 5 years. And he said to me, no, he's going to put a huge balloon on his car. And the extra money that he would have paid to pay off his car, he's going to buy shares with that money. And so what he's hoping is that that cost of that debt, he's going to make more than that by taking that money that he would have paid back on the car and invest it on the exchange. And then at the end, when the time comes and he has to pay that balloon, he's going to have more than enough money to pay the balloon. Risky, right? Risky. But this is what he's working on, hey, leverage. And, okay, maybe he had some insider information or, I suppose his dad was a stockbroker, so his dad always knew which shares were the nice ones to buy. And he was definitely speculating, isn't it? I always do advise students to start investing young, take, that bit of extra money every month and invest. But that's long-term investments, which is that you buy shares and you're willing to wait. For him, it was short-term. He wants to make money, trade, make money to try and make his money grow. So that's leverage. You can borrow money, and if you borrow money at a cheaper rate than what you can make with that money, you can increase your return to shareholders, isn't it? Okay, so that's the traditional school of thought. So the traditional school of thought, when you look at that, and I didn't take tax into the equation because actually, on top of the 12 that I would have to pay interest, I would actually get a tax deduction, isn't it? So it's actually costing me less than 12. It's costing me 12 times 72% because I get a tax deduction of 28. So net after tax, it's only costing me less. Yeah. But if we look back to this traditional school of thought, it seems to make sense to take debt, isn't it? Okay. Then there's the second school of thought. The second school of thought is called Miller and Modigliani. Miller and Modigliani were economists. Miller and Modigliani were economists, and they did research and had theories around economics and finance, isn't it? And Miller and Modigliani say it makes no difference. That's what they say. No difference. They say it makes no difference whatsoever in a business whether you have debt or don't have debt. Yeah. Let me explain to you why Miller and Modigliani said that, and I'm going to explain it with my example. So in my example over here, you were the only shareholder of this business. Any money made in this business came straight to you, and you maybe expected a return of 20%, and that's what you got, and you were a happy shareholder. Do you agree? Now, you are no longer the only capital provider in the business. There's a bank. The bank has given the business 100,000 rand, or it could be 100 million rand, isn't it? It could be any amount of money. I used to have a client that used to say, if you're going to borrow from the bank, borrow big. If you're going to borrow, make sure you borrow a lot, because then they're going to think 3 times before putting you into liquidation, right? So imagine now that this is not thousands, it's millions. So it's 100 million rand, and now you are not such a happy shareholder anymore. Do you agree? Because any money you make in your business, who's going to get paid first? The bank, isn't it? Not only that, but you know this money that we said we could take, the 28. When it was 20, you could take it, isn't it? Go on holiday, spend it, whatever. When it's this 28, can you take all of it? Because what happens when the time comes and you have to repay that debt? What happens then? Then you don't have it, isn't it? Then we're doing these things, which I think people do anyway, which is restructure their financing, isn't it? Which is to borrow to pay back the borrowings that you had borrowed before, kind of thing, right? That's okay, which is normal, I suppose, in business. It does happen. But can you see how this shareholder who expected a 20% return, once we're looking at debt, once we're looking at risk, once we're looking at the fact that he has to keep money back to repay capital, once we're looking at all that, maybe he doesn't expect a 20% return anymore, isn't it? What does he expect? A bigger return, isn't it? So what Miller and Modigliani said is they said that any advantage that you get from debt, is exactly counterbalanced, is contraed by an increase in risk and therefore an increase in the required return of shareholders. So actually, this shareholder who was getting 20% before when the company had no debt is no happier now that he has 28% of debt because he's taking more risk, isn't it? And that's the name of this module. The name of this module or this study unit is called Risk and Return. And it's all about looking at things from the perspective of the capital providers. You're on this side, isn't it? You're borrowing from those people. But you're only going to be able to borrow from those people for as long as they're happy to lend to you or to invest in you, isn't it? So you always have to put yourself in their shoes and say, you're going to invest in me. You're going to give me money for share capital. You are going to lend me money. You're going to buy pref shares or debentures or whatever it is. I need to look at it from your perspective. What do you expect as a return? Because what happens if we don't pay the bank? He puts you into, what happens if I don't pay the bank? He puts you into liquidation, isn't it? So he'll come and take your assets away. Well, quite a few of you work in banks, right? The girls at the back. I think the business rescue. Yeah. So what happens if you don't pay the bank? There's trouble looming, right? What happens if you don't pay shareholders? If they're expecting a certain return and they don't get it, what do? What can shareholders do? Disinvest. Sell their shares as fast as they can. Vote with their feet, isn't it? What happens when shareholders vote with their feet and sell their shares? The share price drops. When you need to get new capital, new financing now, can you? Difficult, isn't it? So that's what Miller and Modigliani said. So now we go back to these two theories. And we see that there's truth in both, isn't it? Some truth. Put it this way. There is some truth in both of these theories. And where Miller and Modigliani starts to fall down a little bit is in the assumptions that Miller and Modigliani had. Because Miller and Modigliani, when they were doing their work, and they actually did work to prove that as your level of debt increased and you got that leverage benefit, so the required return of shareholders went up by the same amount, so that you were always balanced. It never benefited you, right? But what Miller and Modigliani assume is a perfect world, or a perfect market. In this perfect market. There are no taxes. There are no transaction costs. Everybody knows the same as everybody else. Nobody has any insider information, isn't it? And this is the best one. Everybody makes all decisions rationally. Right? And we know nobody does that. None of us do that, isn't it? We all have emotion in our decisions, or expectations, or dreams, or whatever it is. So, because of the fact that this perfect market really does not exist, in South Africa we tend to lean towards the traditional, yeah? But we don't lean towards the traditional 100%, isn't it? So when I have this scenario which I showed you here, which is return on equity is going up from 20 to 28, so this shareholder is getting 8 more, he's very happy. Maybe what we're saying is he's going up from 20 to 28, the increased risk might have taken him up to 25, and he's still getting 28, so there is still a benefit, isn't it, of having debt. But we must be cognizant always that the benefit of debt does have an impact on my shareholder. He does perceive that risk is going up. He does expect his return to go up with that increase in risk. And so therefore we must be aware that that differential is not all, rainbows and unicorns exactly. Okay, so that's risk and return. And if you look at your notes, there's a ratio which we didn't look at last week. It for some reason appears in the textbook in this place. It appears in the textbook under the risk and return chapter, not under the financial analysis chapter. It's called a gearing ratio. The debt ratio and the debt to equity we did see last week, isn't it? It's called the gearing ratio. And they could ask you to calculate a gearing ratio, and all that gearing is looking at is the percentage of debt as a percentage of the total capital in my business, isn't it? Total capital in my business. So I'm saying the total capital in my business is the debt and the equity together. How much of that is debt? And that's gearing. And remember, gearing is almost like a positive thing, which is my debt is helping me to make money for my shareholders, isn't it? So that's what it's looking at. And remembering, of course, that it's good for it to have some, but then when you get to too much, that's bad. Okay. So here's the facts of debt. Debt is cheaper. Debt is lower risk. It's lower risk from the shareholder, from the capital provider's perspective, isn't it? If you buy shares in a company, you have no guarantees whatsoever you'll ever see even a cent, isn't it? Because dividends and capital growth is something that you expect or hope, but it's not something that you have to get. If you are a bank, there's guaranteed interest, isn't it? Compounding even in an agreement, and there's security. They're going to take your building away if you don't pay your bond, isn't it? So there's lower risk, so there's a lower expected return, and it's also tax beneficial. Introducing debt brings financial risk and increases cost of equity. Gearing improves the return to shareholders in good times. Because in good times, we get that 20% return on assets. In bad times, if we only get a 10% return on assets and we have debt of 12, we're then in trouble, isn't it? So should a company take on debt? And there's your two schools of thought, the traditional and the Miller and Modigliani. Here are some of those assumptions about the perfect market. But in conclusion, what we say is that companies do benefit from debt, and so we would have some debt. Okay. Which then puts us into the whole scenario of how do I know what return my shareholders want? How the heck do I know that, isn't it? And how can I work that out? And in second year, when we were looking at cost of equity, you remember that I talked about 3 methods. We looked at something called CAPM. Do you remember CAPM? CAPM is risk-free plus beta, and then market premium, return on the market less risk-free rate. Do you remember that? CAPM. When was the last time you did CAPM? But the ones who did it last year, remember CAPM, right? CAPM. We also looked at a dividend growth model. Do you remember a model that looked like this? P0 is dividend 1 over R minus G. Remember that? And what this model says is that the price of a share today is a function of the perpetuity of dividends, because this is a perpetuity that I'm going to get. And those dividends are going to grow at a certain rate. And so that then would tell me what the required return is. And how does that work? If the shareholder is going to hold shares forever, he's going to receive dividends forever, isn't it? So whatever the share price is trading at today must be a reflection of what that shareholder believes those dividends are worth. So then we can discount those back at a required rate of return, which is then his required rate of return, isn't it? So that the second one here we can only use for listed shares. I need a share price, yeah, and I need dividends. So this one is a listed company. And then the third method, let me stick it down here. The third method is actually not even a formula. It's a method actually that they quite like at sort of an honors level. It's a subjective method. And what a subjective method does is it takes a listed company, or it takes the risk-free rate, and it adjusts for risk. Yeah, so it says, if I was to take my money, and instead of investing it in a company, if I was to put it in the bank, and put it, I don't know, on the money market, in a money market account, you know, something that's low risk or zero risk. If I was to take that money and put it in a zero risk, what could I get? And let's say I could get, what, 7. And then I say, okay, but I'm not investing in the money market. I have got risk, so I need to start adding on for risk, isn't it? So then I say, if I could buy a blue chip, what could I get? Maybe I could get 10. Then I add 3. Then I say, but I'm not buying a blue chip, I'm buying a private company. I can't buy and sell shares when I want. I can't bail out, isn't it? So then I'm going to add another 5. Then I say, oh, okay, but this guy's got a fantastic idea. Nobody's thought of it. He's the first in the market with it. And so I think that drops risk, so I'm going to subtract, isn't it? Then I say, he's small, he's borrowed quite a lot of money, then I add. Then I say, but he's a fantastic entrepreneur, he's made so much money. Somebody was saying to me, oh, it was in my full-time class, they know someone who has invested in all kinds of things and makes a lot of money, a real like entrepreneur, then you would subtract, isn't it? That's what the subjective method does. And it's quite used in practice because it makes you think, isn't it, about what it is really that is giving you risk and making you expect a higher return, and what it is that's reducing your risk and maybe making you expect a lower return. And it starts with, what could I get if I had no risk? Because that's the bare minimum, isn't it? Yes, a subjective, everybody's going to get a different answer. So in an exam, if you got a subjective, the marks are in identifying the risk factors and identifying what they do to the risk. Do they make it go up or down? Not in the percentages, because everybody will do a different adjustment. You might say you need to add 1%. I might think I only need to add 0.5%. She might think she needs to add 2. So we all have different perceptions, isn't it? Okay, but as a manager in a business, or as an owner, or a person who started a business or running a business, you need to figure out how much your shareholders expect as a return. Because if you don't match that, then they're going to vote with their feet and sell your shares. Okay. So how do we go about that? We go about it from the perspective of the investor. We look at how does the investor decide, right? So I said to you that the first model here was CAPM. And this CAPM model actually came, the formula or the principle behind it came, do you agree with me? Let me take a step back. Do you agree with me that this CAPM model hinges on this number, beta? Isn't it? Because look, that's risk-free return. I put my money in the bank, thank you very much. Over here's the market premium. I buy blue chips, or I buy that top 40 index, or, you know. So that one is easy to also establish, because you can just go onto the market and see. So the big thing here, the big driver here is this beta. So this beta is a measure of risk. Beta is something that we calculate. You were told in second year what beta was, but this year you have to calculate beta. Okay, so that's where does beta come from, and how do we calculate beta? It comes from this thing called portfolio theory. Portfolio theory. And if I just give you a brief sort of big picture thing of what portfolio theory is. When investors are putting a portfolio together, they look for shares that correlate with each other to try and reduce risk, isn't it? To try and offset risk. So, for example, I used to do I was involved once with a company that, it was called at that time Cadbury Schweppes. I don't know if you knew that Cadbury Schweppes was the company, Cadbury Schweppes. So they used to do chocolates, and all the Schweppes drinks at that time were owned by Cadbury Schweppes. So it was quite a nice business because, you know, when it's cold and it's wintry and everybody wants, you know, to hunker down, then they're buying chocolates. And then when it's hot and whatever, they're buying cool drinks, isn't it? So the businesses themselves sort of were cyclical, but in opposite directions. Yeah. So if we look at a portfolio, when somebody is putting together a portfolio, they're looking at trying to weight that portfolio with shares that would offset each other in terms of risk, isn't it? So we look at this thing called the portfolio risk and the portfolio return, and then we look at how the shares work with each other to try and get the portfolio return risk down to a low level. So these are some of the things that you may or may not have seen, the more statistical modules that you did earlier. The first thing we look at is return. When we're looking at return on a portfolio, we work with expected return. Do you remember that with the probabilities? Probability times return gives you a weighted or expected return. Yeah. Then, so if we look at this example with this portfolio, there's one company, there's the different probabilities, there's the return, so expected return is 8. So if we're working with a portfolio, then depending on how many shares of A and B we have, and in this case I'm assuming a 50-50 split, then we would take 12.5 times 50 and 20 times 50, and we would get a return of 16.25, right? So that bit's fairly easy. And this is the grey part, I think, in your notes. But as I said, it's just background. We're getting to CAPM. You know, that's what you need to be able to work out. CAPM and beta. Okay? Then we turn our hands to risk. And risk is the probability that the return will differ from the expected. Let me show you on a graph how we would calculate risk. So if this is a share, and let's assume that my returns, different returns that I get on this share, look something like this. Okay. Do you agree that if I had to plot a straight line through that, the expected return, it would be somewhere there? Do you agree? Okay. Risk is how much my returns differ from this expected value. That's risk. That's how I measure risk. I measure risk by looking at how much the return differs from the expected value. The bigger my differences, the bigger my risk, isn't it? But look, risk can be good. Higher risk, higher return. Nice, hey? But also lower returns, isn't it? Bigger movements, hey? Bigger gaps. If I put in another company which has the same mean or the same expected value, it could be a company that looks like this. Do you agree? That company also has the same green line. Yeah, the green line is still going through the middle. It's still the expected. But look at the risk on that one. Small, isn't it? Small risk. So when we're looking at those two, which one is high risk? Black. Which one is low risk? Blue. But look, high risk, also higher returns, higher losses. Blue, lower maximums, lower minimums too. Yeah. So when we're looking at risk, and this you must have remembered from stats, it's the deviations. We look at the standard deviation. You remember that from stats. We look at the standard deviation. On yours, I think it's all on one page. So let's see, it's over here. And when we look at the shucks, I have to show you a bit on that page and then a bit there, but let's start here then. So if we look at it, here's my example. And I didn't tell you what the difference was. Okay, so there's your probabilities. That's how much cash you would get. That's the expected. Yeah. So there's 25% probability that I'll get 600, my expected value is 150. There's a 50% that I'll get 700, my expected is 350. Yeah, if I carry on, there's a 25% that it's 800, that's 200. Yeah, 100% probability, my expected return is 700. Do you agree? Then I look at how much my actual moves compared to my expected. So my expected was 700. Remember that, okay? So if I go back, so I'm trying to work out risk. It isn't something that at honest level I've seen people, they expect you to be able to work it out, but at third year it's just to take you to beta. So my expected was 700. When I make 600, I'm making 100 less. There's my deviation. When I make 700, I have no deviation. Yeah? If I move forward to the 800, I have a 100 deviation going the other way. Okay? Now what I do is I square my deviations. The reason I square my deviations is because I don't want the ups to offset the downs. Do you agree? Whether something is different from what I expected to the positive or to the negative, both are bad, isn't it? And in fact, when we talk about shareholders, we always talk about, you'll hear me talk about, we want our shareholders to be happy, which means we must give them what they expect. Giving them too much is almost as bad as giving them too little, because they start to wonder what's going on, you know. Why are you getting such a big dividend? What is going on with the company? Are you about to fold? Are you selling off all your assets and you're going to, you know, not trade anymore? Why are you giving me this money, you know? So we then square it. So what I've done is I've squared to get rid of the minus. Do you agree? To get rid of your minus, you square, because when you times a minus by a minus, you get a plus. Yeah. So I square it, and then I've squared it. I root it again. To get back. No, I don't. Sorry. I times by the percentage. So I square it, and I times it by the probability. So there's a 25% probability that this will be my squared deviation. I can, but I promise you that you don't need it. But yeah, I'll print it. Let me see. I'll change it all to black. The reason I put it in grey is because I don't think it's important that you need to work through. Okay, that was the reason I had it in grey. Okay, and then here I do the same thing. So what have I done? I've worked out what my expected is. I've worked out how it deviates. Then I've squared the deviation to get rid of minuses and pluses. Then I times the deviation by the percentage probability that it will occur. Yeah, and then when I add it up, I get the variance. And then when I square root it, I get the standard deviation. Yeah, so this standard deviation is 70. So what that means is that on average, I can expect my return to be 70 more than 700 or 70 less than 700, isn't it? That 70 means something more if I look at it as a percentage of the 700. Do you agree? And so that's this one, coefficient of variation, which is 70 over 700, 10%. Now, does that make sense to you? 10% risk. That sounds better, isn't it? If I said to you there's 10% risk, that sounds quite good, actually. It's not so bad. 10%, you can live with 10%, am I right? So that's how we work out risk. But now, in a portfolio, the risk doesn't stand on its own, because the shares correlate with each other, isn't it? When we did expected return, all we did was we said the weightings. But unfortunately, in a portfolio, not only do we have to take into account the weightings, so I have two shares. One I have 50% of, the other one I have 50% weighting in my portfolio. One has 10% risk, one has 50% risk. I can't just take them and add them together. Why? Because the risk of each might offset or might compound, isn't it? So when we're looking at portfolio risk, it's measured by the standard deviation of the portfolios. And look, this is weighting, risk. Weighting, risk. Do you see? X share, Y share. But in addition to that, I also have to look at this P, which is the coefficient of correlation. We just worked with coefficient of correlation this morning, in MAC. R on your calculator. And we just worked with that this morning in MAC 3701. And this coefficient is then going to either make my risk bigger or smaller, depending how they correlate, isn't it? If they negatively correlate, which is what we want, when one goes up, the other one comes down, so that they balance each other, then that P is going to make my risk smaller. If they don't negatively correlate, if they positively correlate, in other words, when the risk of one goes up, the other one also goes up, and then I'm going to have the risk getting bigger. Yeah. So here's an example, just to show you how it would work. There's a return on A and B. And you can plug these into your calculator the way we did earlier if you wanted to. There's your risk, your theta. And then R works out at a negative 0.03. A negative correlation is what we want, isn't it? They go against each other. But it's very weak. Do you see? It's very weak. 0.03, 3%. That means they actually have nothing to do with each other, really. What drives the risk in the one is completely different to what drives the risk in the other, so they don't really match each other in any way, shape, or form. So then the portfolio risk, if you plug it into that form, standard deviation of 5.42, which you then could compare with a different portfolio, or you play around, isn't it? And you say, okay, instead of having share A and B, what if I buy share P? And then let's see what that does to my return, isn't it? Diversification is where we include investments that move in opposite directions so that we can get rid of some of the risk. And we talk about two different types of risk, a systematic risk, a market risk. And that you can't diversify, right? That's because you don't have your money under your mattress. Yeah? You're going to take risk. Unsystematic, you can diversify. So that should be an and. Firm specific, and you can diversify. So the more shares you buy, the more you can diversify that risk, isn't it? So we then move on to CAPM. And CAPM is then using all these theories about risk and return to help us determine a beta. Okay, and I'm not even going to show you this formula. I want to get to beta. Because this is beta. You remember the CAPM formula, isn't it? Let me show you what... a picture of beta, and I'm sure I've also shown you this picture of beta. If this is a return on a market, okay, so that's RM, return on the market, yeah, and I have a company whose returns look like this. Beta is equal to 1, isn't it? When the market goes up, I go up. When the market comes down, I come down, and it's by the same sort of amount, isn't it? My share has the exact same risk as the market. It doesn't go opposite to the market. It goes exactly the same, and it's the same risk. Then I have a beta or another share that looks like this. That share has a beta bigger than 1. Because look, when the market does well, they do extra well. But when the market does badly, they do very badly. Bigger risk, isn't it? Bigger deviations. Beta, bigger than 1 in that case. Then I might have a share that looks more flat. Like that. When the market goes up, it doesn't go up as much. But when the market comes down, it also doesn't come down as much. And it's a much less risk investment. And in this case, beta is less than 1, isn't it? We have to try and... In second year, you were told what beta was. Beta is a measure of the company risk in relation to the market. And you can see where the portfolio theory is coming in, because we're going to look at how this share correlates with the rest of the market. In portfolio theory, we looked how the shares correlated with each other, isn't it? So we're going to look at how does this share correlate with the market. So if we look at this formula for beta, the formula for beta, and this is new now, you haven't done this one before. The formula for beta is the covariance of the share I with the market. Covariance is how does the share vary with the market? Does it vary the same, more, less, negative, not at all? How does the share co-vary with the market? So this is... And if we look at this formula for this covariance, it's made up of R, which is the coefficient of correlation. Hey, times theta of the market, risk of the market, yeah, times theta of I, of the investment, the risk of the investment. So this is coefficient of correlation. How do the two correlate? How do we get this R? We have to look at observations, isn't it? We look at history. We look at the return of a share compared to the return of the market over a period of time. This is the risk of the market, and this is the risk of the company. And I showed you in portfolio theory how we get to those numbers, isn't it? Because I showed you how we do that risk calc. It was that graph of mine where we were moving big movements to the norm or small movements to the norm. That's the risk. And then we take this covariance of the market to the share, which is measured by this correlation, risk of one, risk of the other. And then we divide by the risk of the market. Because remember what beta was. Beta was the risk of my share in relation to the market, isn't it? That's why I divide by the risk of the market. Then I divide by the standard deviation of the market because I want to get beta. So that's a formula for beta. Here is an example. I want you to see if you can get the answer. Let me just leave it like that. Okay. On your calculators, if you know how to do it, you should be able to get R. Yeah? If didn't work. So that's just your XY, 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 and you should get R. And then you should also be able to get beta. So to make your percentages either wholes or percentages. It shouldn't matter. Yeah, it shouldn't matter. Did you put them in as 0.238 or did you put 23.8? Should work. Because it shouldn't matter what they are, right? Okay, so let's see who doesn't remember how to use their calculators in this way. Okay, there's a XY button. There should be like an XY button of sorts somewhere.
It's been a while. I will calculate as well.
It's fine. They don't change. So it's just a question of being able to put it in. You see, there's R. Do you see there?
Yeah. That's
Once you're able to put your data in, that's your R. Do you have it? Yeah, or you can download it. See, there's your XY, and that's data. So I think what you do is you put the first number in, you press this button, you put the second number in, and you press data. Try that. Just make sure you clear everything first. So on this calculator, which is the button? That's the XY button? Like the number button, is it 3 or 4? So you put in your X number, then you press 4, then you put it in again and you press swap. Okay, so where's input? Shift 4, shift swap. Okay. So you put in your data like that. So you start with 23.8, shift 4, then 38.6, shift swap.
Confucius on this one. So it's 28.3 alpha, and it's that stow one. Is it right? No. What would you say?
Yes.
Okay, and
Then your second one.
which is going to be 38.6.
Yeah.
38.6, and then I'm going to stow it again.
I don't think it's that. I think it's data. It's XY data. XY data. Try that. Do you have a financial calculator? Not here today. Which one is it that you have? The same as his. Okay, then he'll show you if he's trying to figure it out. Does it work at all or not?
You see these buttons, I don't know what's, because stats is for all this brown, for the R and stuff, and then X, Y.
Are you in stat mode or not?
No.
Second function, stat. Okay, let's try that. 28.3. 3.8. Where was it that I said to you it was?
There's actual button there, see?
Oh, there. XY, CX. Because you went the wrong thing. Let's just try 38.6 data. N1 means it's the first observation. So as you go through, you'll see 1, 2, 3, 4, 5. You should get up to N5. Okay, so just keep putting it in and it'll say.
Press 23.8.
Did you get 91? Okay, so once you have 91 and you have these, you're able to get these, then you have to unfortunately plug into the formula. Okay, brilliant. Okay, so they could ask you in an exam, where in second year to work out your cost of equity, you just plug the numbers into beta. They could give you into the formula and they would give you beta. Now they will give you information to work out beta to then plug into the formula to get cost of equity. Okay, I'm sorry about that. Yeah, try these. You must first put your clear to clear the stat registers, and then I don't think you have to put yours into stat mode at all. Is it working? Do me a favor, that lady has a shop. She figured hers out. Say it, yeah. So your shop, her shop is a bit different to yours, but it does also seem to have the arrows, yeah. No, you're just working out R. So you're just going to go recall R. But you got 91. You haven't put everything in. All right, did you work out your thetas? There should be a thing there that says theta X, theta Y. Yeah, these little blue buttons.
Theta X, theta Y.
No thetas. There it is, there. Sorry, not blue, orange in that case. And then swap to get the other one. Let's see.
0.87 something. Because now I went second function.
R. And that's what you got. And you put in all your data, huh?
Yeah.
Okay, just do me a favor. Clear all your registers.
Data and change it or something.
Can you? I don't know. No, I don't know. But otherwise, check your data or clear everything again and try and put it all in. Do you get that?
So which one does this one become?
No, you should be able to go straight there.
After we do that, and then do function swapping.
Well, that gives you the one, and then when you swap, it should give you the other. Then it gives you the other. Because it's theta X, theta Y. So you're getting X first, and when you swap, you're getting Y. Do you understand? And did it work? Okay, will you help him? Or he can come to you? Or? So now everybody's... Is that on? Just switch it on. It's hot? Yeah. Just turn it like full blast. It makes a noise, but it's cool. Is it cool? You can turn it some more, all the way. Yeah. There we go. Better. Did you manage to get it to work?
Yeah, we're just gonna.
Good job. It's the same. Here's another pupil for you. Huh? The? Yeah, it's also there. Look, there it is.
Oh.
And then you just do swap to get Y. Have you still got the data in?
No, I cleared it.
There it is there in number 9. You see it says theta X, theta Y. So go there and then do swap. But try it. Yeah. 13.52. You didn't get the 13. It's number 9 on your calculator. So it's orange 9. Go orange 9. Have you cleared it? Then you do orange 9, orange swap, and it'll give you the two numbers. Because if... Oh, how did you get beta? And it gives you beta. Let me see.
So,
Really? But where does it say beta? Does it say beta there?
well, that's what I understood that you said. That
Oh, no. I didn't even know you could get beta straight off your calculator. Can you? Yeah. Well, tell me how you got it. Is there a beta button on your calculators? Yeah. Now, theta y dx. Make your things bigger because it's 13.52. Put 4 decimals on or something like that. Can you? Display 4. I don't know. There we go. 1352. Do you see? And there it is. There. And theta y, theta x. Yeah. Yeah. And then what did you do?
I'll go to, because remember we did the A and the X axis, then I'll do those, swap, there's the answer.
But I don't know what that means. It's M. But I'm not sure if it's if you're getting the answer by fluke or not. That's the only thing. But there's your Y and X there. So if you go there, just keep your data. You'll go there and 9.
And then I just wanted to press swap, so then I get a number, so then I go 9.
Yeah. There's 1352,
Okay.
and then you swap and you get the other one. No, that swap. This swap.
Did I break it now?
Did you break it? Okay. Are we good? Did you manage?
I can't get this answer. Try you. Maybe I'm making a mistake. Yeah,
Now you got one.
yeah 1 and 8.9 something. And did it twice and I got 1.
Second function, clear all. I'm wondering, you have to be in stat mode. Yeah, in stat mode.
Yeah.
Did you, when you put this in, did you put it in as a minus?
Yeah, I put 7.2, then I put a minus, and then I said, maybe, but
Is it? No, I think the others did it. It didn't make a difference.
directly, but I can try it, just to be sure. If it comes around, then you're right.
I tried it the other way around, but just couldn't put active in it, so I had to do the 0.23.
Did anybody manage by putting in whole percentages or not? Yeah, by putting it in as 8.2.
I'm sure, man, you don't have to divide the answer.
No, I don't think so.
It's a direct thing, just, but we can try it both ways.
I don't know. You're going to have to go and check.
But I have
But
the
then,
manual there.
yes. But I don't think we're doing anything wrong. I don't understand really.
Is it not maybe the points or something? But just now I did get 0.97 something.
28 point. No.
Then minus is close to 4.
Stat. No, really. I used to use a HP 12C, which was, it works fine. No, you shouldn't need a new calculator unless you want to get one, but you don't. You don't. Really, you don't. No, it's just. Yeah. Yeah. I like the sharps, especially this one. That other one is like horrible, but this one is straightforward.
But you do get it, if you put it in like that, sorry, George.
Yeah. Or online. I usually just get it online. And then you do. Ah. Now I got 89.9. You see, theta y is working. 2373. No, just, I don't know, just maybe there's a maybe, just try putting it in carefully. It has to be in stat mode, eh? Yeah, it doesn't work. Just try putting it in carefully again. And? All right, so next week, we're going to start looking at WACC. When we look at WACC, you have to work out cost of equity. You may need to do beta to use CAPM to work out cost of equity to put it into the WACC, right? Well, after we do mergers, we're going to do WACC. But for now, this chapter was just introductory. It's just an introduction to debt and equity. And the next chapter is a almost theoretical chapter which deals with debt or equity finance. And there are a couple of questions in the assignment number 2, which I don't think I've given you copies of, or have I, assignment 2? No. I don't know if I've made copies. I'll have a look. A WACC question. Yes, a WACC question. Or it might be a valuation of a company. So you might be doing a valuation of a company for a merger, for an acquisition, and then to do the valuation of the company, you have to work out the cost of equity, and to do that, you have to work out beta to use CAPM. You know, it won't be just work out beta, or it's unlikely to be that. Okay. So we agreed so far today that debt in a business is acceptable and beneficial to some extent, isn't it? So we should always try to have a balance of debt and equity in our business. So when we are looking at financing decisions, there are a couple of rules, 2 rules. Rule 1 is, I call it the rule of like with like. And what it means is that if I have short-term assets, I should look for short-term financing to finance those assets. An example, inventory, I finance with payables. Yeah, I get my suppliers to finance my inventory if possible. Or I finance debtors with an overdraft. Medium-term assets, I finance with medium-term finance. And in this case, I'm looking at assets like computer equipment, trucks, machines maybe, and medium-term assets I should finance with medium-term finance. And so far, actually, if I come back, short-term finance is debt finance. It's things like overdraft or payables. Medium-term finance is also debt finance. It's installment sales, it's finance leases, it's bank loans, isn't it? It's that kind of stuff. Because I'm looking at something that's between 3 to 5 years. I'm not going to buy a truck which I'm going to use for 5 years and issue shares which are going to be in my company forever. It just doesn't balance, isn't it? And then I have long-term assets. And long-term assets are things like properties, things like acquisitions if I buy other companies, things like if I set up new plants in a new location, if I expand and I set up a factory, even if I expand globally and set up operations in another country, yeah, long-term assets. And long-term assets, I should use long-term finance. Examples of long-term finance are loans, debentures. Do you know what debentures are? I think I say this. Some of you may have heard me say it before. Debentures are loans to individuals. So as an individual, you buy a debenture in a company. It's like you're lending the company money. The company needs to raise 10 million rand. They have the option of going to Investec and asking for 10 million rand or issuing debentures. If they issue debentures, 100, 1,000, 2,000 shareholders, individuals can buy those debentures. And they each give a bit of that 10 million rand. But otherwise, it's structured exactly like a loan. There's an interest coupon. You have to pay that interest quarterly, annually, half yearly, and they redeem at a certain amount, sometimes with a premium, sometimes without, isn't it? So it's exactly like a loan, a debenture. But on the other side of a debenture is not a financial institution, it's an individual. And the debentures trade on the bond exchange. So that's the other benefit of debentures, is if you've lent or bought this debenture, but now you want your money, you can sell it to someone else, and then they will continue to receive those streams of income or cash, interest and capital, and you won't anymore because you've sold the debenture to them. They trade. Yeah?
Sorry, I've always gotten confused with debentures. Debentures is the company needs money.
Yes,
right?
and issues debentures.
So they issue out debentures. So they're asking for people to finance them.
Correct.
So they issue out like
Debt.
debt, like they want to get loans.
Yes. So instead of issuing a share, they issue a debenture. If they issued a share, that shareholder is entitled to nothing because you could pay dividends or not, and you'll never pay him back. If you issue debentures, this guy's guaranteed to get that interest every year until the term of the debenture is finished, and at the end, you get your capital back.
And that debt financing through the ventures, obviously the individual will earn more interest than what they would have if they had it in savings ventures and banks.
Yes, the debt,
That's the benefit.
the cost of a debenture, or what the interest will be if you're looking at it from the other perspective, the shareholder or the investor, sorry, I say shareholder, the investor, is that, of course, he's going to want an interest that's commensurate with the risk he's taking. So if he puts his money in the bank, he gets 7% because there's low risk, isn't it? Depending on the bank, I presume. But with a debenture, it depends what company you're giving money to. If you're giving money to SA Breweries, it's very different to if you're giving money to Joe Bloggs down the road, isn't it? So then the percentages are different, yes.
Be like your dividend comes in as your interest.
Your dividend is interest in your hands, and in the company's books, it's interest. It shows in the P&L as interest paid. And there's even a tax deduction on that interest on a debenture.
You're up to a maximum one, or is it fully deductible?
In a company, it's fully deductible, yeah. In the individual, your income is taxable over a certain point. So, long-term finance, long-term loans, mortgage bonds, long-term debentures, but debentures could also be short or medium-term. You can do a 3-year debenture, isn't it? Whatever. It depends what you're buying. So, when I gave you the example of SA Breweries. If SA Breweries was buying trucks, they might do a short-term debenture because trucks are only going to be around for, 5 years, whatever. But if they were, like they bought a brewery in Australia, if they were using debenture finance to finance that acquisition, that would be a long one, isn't it? Because that brewery is going to be around for long. So that might be a 20-year. So it just depends. You can structure it however you want. If you structure it in a good way, you'll get lots of people wanting to invest. If you structure it poorly, nobody will want to give you money. It's exactly the same as when you go to the bank, isn't it? So loans, debentures, and then we have shares. We have 2 types of shares. We have prefs and we have ords. And prefs and ords tend to be equity, but sometimes prefs are not equity. And we just need to be a little bit careful with that. We see it in financial accounting on the other side. If I issue a preference share and it's redeemable, and if it's a compulsory redeemable preference share, it means you have to pay dividends and you will redeem it. It looks like debt. It is debt. Right? And actually, when we pay dividends to compulsory preference shares, we actually call it interest because it's debt. It's a debt instrument. We called it a preference share, but it isn't actually. If it's a normal preference share, that you never have to pay a dividend. If you don't pay an ordinary dividend, you never have to pay a pref dividend. And you never have to redeem a preference share like that. So in that case, it's equity. So pref shares is what they call them hybrid instruments. They're sort of on the fence, and it depends how they look, whether they are debt or equity. But pure equity, ords. Yeah? Which brings me to rule 2. Rule 2 is that for long-term financing options, the decision about or equity is dependent on the optimal equity ratio. I talked to you earlier about the fact that when I issue debt, the required return of shareholders goes up, isn't it? There is an optimal level of debt to equity. It's the level where you're benefiting from issuing debt. I showed you that whole story, hey? There comes a time where the more debt you issue, it starts to flip. the benefit that you're getting is less than what the shareholders are expecting as a compensation for the increase going up, and it flips, isn't it? So I have a benefit of 12. In my previous example, I had a benefit of 8. But because I've got so much debt, imagine my debt is 100 million and my equity is only 1 million. The shareholders are going, whoa, they're expecting 10% or 12, and you're only giving them 8. It starts to flip, isn't it? There's a level at which there's an optimal debt to equity ratio, and that's what we use. And I'm sure you remember that from second year as well. We do a calculation that looks something like this. Current equity, 100 million. Debt, 100 million. I have 200 million. I have a new project that I want to finance. The new project is 50 million. Yeah? And I have worked out that an optimal debt to equity is 60-40, let's say. Or, yeah, let's say it's 60-40. I think it's not going to work. Let's make this another 100, just to make it look better. I don't know if it will work with 50. So then I say, okay, I will have 300 million of capital. I currently have 200. I need another 100. I'm expanding. I'm going to need 300. I've worked out that my optimal debt to equity, and the way we work that out, you'll do calculations of that in honors, is that we actually play with numbers, and we play with them, and we see what would shareholders think if this happened? What would happen to share price? What would happen to dividends, because do you agree that the more debt you have, the less dividends you can pay, isn't it? When you're paying less dividends, then it affects the share price, which means that the shareholders is not getting the return he wants, isn't it? It all plays. So 200 plus 100 is 300 million. In this share, 60-40, it is 120 there and 180 here, isn't it? And then if I work backwards, so I work like that. And then if I work backwards that way, then to finance this, I need to finance 80 through equity and 20 through debt. Yeah, there's actually two options for this 80. I didn't actually touch on the second option, because usually the second option is not something we would normally look at. We're looking at share issues. And when we look at share issues, there's a number of different ways you can issue shares. You can do a rights issue. A rights issue is a share issue to existing shareholders. Yeah? So I go to my existing shareholders. I say to them, don't you want to buy shares? Yeah? I can do a listing. So I'm a small company and I list my shares and open my shares up to people, isn't it? Or I can just do a new issue. If I'm already listed, I can just do a new issue of shares. So, but the cheapest and quickest is this one. Existing shareholders, I send them a nice letter in the post with a little nice pamphlet saying this is what we want to do, and make them a nice sweet offer, isn't it? The shares are trading at 10 Rand, but if you buy, we're going to give them to you at 8 Rand. This is what we're going to do with the money you give us. In 3 years, we expect it to be worth 12 or whatever it is. The other option is to use retained earnings. Retained earnings is dividends that you haven't paid out. Dividends retained in the business. Now, normally, retained earnings are used in businesses to maintain operations. We use retained earnings. Companies keep back money always. They don't pay everything out. They mainly are keeping back just to be able to keep replacing assets, isn't it? Because remember, when you keep back retained earnings, you're keeping back cash, isn't it? So the rule for retained earnings or using retentions for investing is that we use retentions when we are maintaining operations to replace assets that have got old and need to be replaced. But when we are expanding, then usually we need new capital. And it makes sense, isn't it? I'm just replacing assets I have, I keep the capital I have. If I'm expanding, growing bigger, new capital, new shares or new debt. Yeah. So here I would probably issue shares, maybe prefs. That story that I gave you about SA Breweries buying that Australian company, they issued prefs. They did a new pref issue to cover that. And then the 20 million, the debt, there's so many options available, isn't it? You can get foreign loans, you can get local loans, you can issue debentures, you can get money from, there are people that provide like startup capital. You might even get some money from government, depending where you're going to start this business, isn't it? If it's an area that they're trying to boost employment in, then and you agree to employ a certain number of people, maybe government will give you money at a cheap rate or maybe free. So there's all your options. Yes, that's right. The Department of Trade and Industry gives loans, yeah, as well. He goes there. Really? And they give?
But for existing businesses, not to start up.
Yeah. But in this case, it was existing, right? Oh, so he goes to DTI. I didn't know that. Okay, and the more times he borrows and pays back, the more happy they are the next time to lend him because they know he'll pay back, right? Yeah. Okay. Yeah, it is, eh? It's the first time I've heard of that. So these are your two financing rules. Rule 1, like with like. So I will always try to match. And rule 2, when it's long-term financing, optimal debt to equity ratio. I try to get to that optimal debt to equity ratio. Okay. Assignment number 2. And I'm not sure if I have assignment number 2 printed for you. Let me put it up on the board while I go and make a copy for you. Is a discussion-ish question. Oh, assignment 2 is awful. I mean, I don't know. It is just awful. It's like all discussion questions and that one. How do I get rid of this thing here? Never mind. Okay, so this is this first question is worth 40 marks. We're not going to be able to do all of it today. You can see the first bit asks you to calculate the cost of capital for 11 marks. We won't be able to do that today. Part B is what I want you to have a quick look at now. Prepare memorandum to the Board of Directors where you critically evaluate each of the directors' views on the appropriate funding instrument. C is with supporting calcs, demonstrate the company's ability to raise debt or equity or both if working towards a target capital structure, which is that calc I've just done, isn't it? Which is, if I want a target capital structure, should I be issuing more shares or should I be getting more debt or a combination? But I want to do C using market values. Do you agree that if we use book values for C, we're going to get real rubbish, isn't it? Because your loan, your debt is new. It might be new. It might be a couple of years old. But your share capital might be 20 years old, isn't it? If we put those numbers onto a calc, you know my calc that I started where I said here 100 million, 100 million. If we used book values, this might be 10 million and this might be 80 million, isn't it? Then we have a funny warped view of how much equity and capital we have. So do you agree we should use market values? So that one we'll come back to once we've done, sorry, no, it's not even there. Once we've done this cost of capital, we will have worked out the market values of all the capital, then we'll come and do that one. And then qualitative factors for the project. So that's question 1. I will print it for you, but I'm just going to go to that page where they talk about what they want to do. Here they are. So let's just read it from the beginning. Simon & Son are a medium-sized manufacturing company, and they're highly dependent on electricity, which is quite normal in a manufacturing environment, isn't it? Due to recent load shedding, production and profit is under massive strain. I used to have a client that worked 24/7. Even if they lose 3 hours of production, if you work 24/7, you can't make it up, isn't it? If you don't work 24/7, you can make it up overtime, weekends, isn't it? But otherwise then you can't. So it was having a big impact. But even if you can, then you're having to pay overtime rates. So that could be the difference between profitable or not profitable too, isn't it? production and profit is under massive strain. They've decided to invest in a solar power system to minimize this impact. And because they say there's no other solution to this national crisis. The project is 16.25 million. Okay? That is the cost, I think, of things like this. We're talking big money. I once did a feasibility for a client, and it's huge money to actually go off the grid, you know, if you want to be able to go off the grid. It's just so much money. And you really have to be losing a lot to make it worth your while, isn't it, to do it? The 3 directors are still not in agreement. Where's the little scroll thing here? Oh, the 3 directors are not in agreement. No, I think I must use my computer screen rather. It's too funny there. The 3 directors are not in agreement about how to finance the project. And they've tasked your team, your consulting team, to investigate the 3 options on the table as possibilities, and they will make a final decision based on what you give them. And all that stuff is what you're going to give them in the final report. The MD. The MD says that the project should be financing by issuing new shares, as debt finance is riskier than equity finance. That's what he says. Okay. Then the COO, Chief Operating Officer, he says that the project should be financed through issuing cumulative what does it say? Oh no, sorry. Where? Yeah.
Right, down, it's document language. Go down, it says convert. About just to the left, there's a little arrow there.
This one? Ah, there we go. So sorry, where's the stories now? Up here. I just want to make it a bit... Oh, no, it didn't really help because I'm trying to get it all on one page. There we go. I'm going to print for you, but for now I'm going to leave it up here. He's the COO. He's of the opinion that we should finance through issuing cumulative redeemable preference shares. Now look at this, cumulative redeemable. It sounds like equity or it sounds like debt? It sounds like debt, isn't it? Okay. He believes that this instrument is cheaper than other debt instruments available to the company. And the last one, finance director. She's of the opinion the company should use a mix of debt and equity. Unfortunately, she was not able to support her recommendation with proper reasons, as the meeting had to be adjourned due to time constraints and other meetings. Your management team was tasked to critically evaluate each of the views, to calculate cost of capital and establish the ability of the company to raise debt or equity. Critically evaluate. Yeah? So you're going to look at what each one has said, and you're going to criticize it. Is it true? Is it not true? Why is it true? Why is it not? Why is this a good way to finance? Why is it a bad way to finance? It's all theory, right? How many marks was it? Something like 14. 14. So 14 divided by 3 is 4 point something. 5. I want approximately 5 bullet points, 5 bullet points, 5 bullet points. Okay. You can sit in groups or pairs and discuss. When I come back, I'm going to put it up. What you say. I'm going to go around and say, what do you think? What do you think? Or do you want to do it by yourselves at home? No. Oh, right. You can move on. Okay, let's see. Shall we have a look? So the first person was the MD. Is that right? What did the MD say? New shares. Okay, so we need to critically evaluate, isn't it, what he says? Okay, so tell me what you think. What can we say about the MD's decision to do new shares? What's good about it or bad about it?
We said the first one that it's bad because you're giving away a portion of the company and all future profits.
Okay, so you lose control, right? You lose control if you issue more shares. The long-term profits of the company are going to be shared among more shareholders. Another group at the back here. What did you say? Anything?
So if it's only just
Yes.
To lose the advantages of leverage if you issue a bit of debt as well.
Okay, that there should be debt too, as well as shares. But why did you say that? What would be the problem of just issuing shares?
Saying if you don't issue shares and lose the debt, there's also certain benefits coming with the financing of debt. So we really more into financial opinion to have both trades mixed. So this guy is looking at the shares part. So
Yes.
if only using shares, he's going to lose the leverage benefit that comes with issuing debt as well.
I don't understand.
He's reading the wrong one in there.
Yeah.
So we said there's a drop in the market as well. You might not be able to pay off your debt as well.
Okay, but yeah, it's just shares. This one is just shares. What are some of the other things about just shares?
I think also, we looked at the number of time that it's going to take to issue the shares and also the time it will take the shareholders to decide that they're going to buy in the shares. So it might take longer and we are to be more expensive to actually raise this kind of thing.
Okay, so it might be more expensive and time consuming to raise the capital if you're going to issue shares. Okay. What do you think about, what was that first rule? Long term, long term. How long is the project going to be here for? It's a solar plant. Forever, isn't it? So in terms of that, don't you think it's good? It's a very long term project, isn't it? So it's a very long term project. So therefore, we should use long-term financing, and therefore issuing shares might be a good idea, isn't it? Yeah.
With new shares, it's not necessarily a must to declare dividends.
Correct. No cash flows required. If I issue shares, I never have to pay anything to anybody ever again. There's no cash flows that are required. So that's good, isn't it? So some of the bad things is long-term profits are shared by more shareholders. And over here, I would say more expensive. It's quite an expensive type of financing, isn't it? Issuing shares, because you have to pay forever. You have to pay back profits among more people, isn't it? There's the bad side is that you lose control if you issue to new shareholders, isn't it? But that's only if it's new shareholders. If it's existing shareholders, then you don't lose control. Yeah.
Existing shareholders are more understanding because they know exactly what's going on in terms. So if you issue a rights, if you do like a rights issue.
Yeah. A rights issue may be easier. Be easier and quicker than even raising finance, isn't it? Because look, 16.5 million rand. Do I have to do backwards somersaults at the bank to raise? Is it 16.5 million? Yeah, pretty much. But if you're going to existing shareholders, then it's easier, isn't it? So if it's a rights issue, it may be easier and quicker to raise finance this way. You can see that what I've tried to do is I've tried not to decide up front what I think is best or not best, just to answer the question, which was critically evaluate each person's comments or suggestion in terms of financing. The MD's suggestion was to issue new shares. What's good about it? What's bad? There are some good things. It can be quicker to do if it's to existing shareholders. It can be, it is a long-term proposal, isn't it? So in terms of that, this solar plant's going to be there forever. So why not have shares that are going to be there forever, isn't it? There are no cash flows required. I don't have to pay dividends. So in terms of future cash flows, all those future cash flows can then be put to other use, isn't it? But it is the most expensive. It is time consuming and expensive to raise capital. All those long-term profits disappear. We lose control. We've got 6 out of 14. So far so good, right? Okay, next. What was the next one? It was the COO. What did he say, the COO? He said cumulative redeemable prefs. Okay, cumulative redeemable prefs. Okay. Comments? Someone else? What did you say about the cumulative redeemable prefs? What's good, what's bad? Is it a good idea, is it not?
I think what we said was that you fund the reduction of profit allocation for the next year, for the following year.
Okay, so is it something to do with the fact that they're cumulative? You have to pay dividends. Dividends to the pref shareholders before the odds, isn't it? That's what cumulative means. I have to pay before the odds, and it's cumulative, which means that if I miss a year, I have to catch up. Yeah. So cumulative means that I have to make up all the dividends I didn't pay before I can pay an ordinary dividend, isn't it? Only if you declare, yeah. But you know what? If you issue these and you don't declare dividends for 3 years, in year 4 when you declare, you have to pay them 3 years first before they're cumulative. If you didn't declare, because they're cumulative, so they accumulate, yeah. No, ordinary prefs, you can only pay a pref. You can only pay an ordinary dividend after a pref div. So if you declare an ordinary div, you must first pay the pref div. But cumulative ones accumulate. So if you haven't paid for 3 years, you have to pay those 3 years first before you can pay an ordinary.
What I'm saying is that they have to pay and should pay.
Yes. Look, if they choose never ever to declare dividends to anyone, they will never have to pay. But that's a dangerous thing. Yes, no, it's true. If they never choose to, they don't have to pay. So I suppose you can put that on. Don't have to pay dividends. You may, yeah. Don't have to pay the dividends if you don't want to. But then you can never pay an ordinary dividend. Yeah.
No, I just always thought that it cumulative was if you
Oh, yeah. You have to go back.
I always thought that if you couldn't pay this year, you couldn't pay, it accumulated to next year. So that you therefore you never pay ordinary, you don't pay pref.
Next year.
You declare, you pay cumulative 2 years, pref and ordinary.
Yeah, so isn't that what I've said?
No, but what I'm asking you is if you didn't declare in year 1.
Yes, they wouldn't have to pay in year 1. But when year 2 comes, they have to pay 2 years in year 2. So we're saying the same thing, aren't we?
Yes.
What she's saying is that, for example, in 2014, you did not
Pay any dividends, so nobody got.
You didn't declare anything.
Yeah.
So you're like, okay, this year we don't declare dividend. In 2015, you did not declare dividend at all. But in 2016, you declare a dividend. Okay, to all shareholders. So now to the cumulative shareholders, you still have to pay year 1.
Yes, yes. Yes, you do. Yes.
That's the one to get.
Yeah. No, cumulative accumulates. So even if you didn't make any profit, cumulative pref shares usually have a coupon, have a fixed percentage. There's a fixed percentage with prefs. Fixed percentage. So that's the other thing. You don't have to pay dividends. You can't, but you don't have to, but it's not advisable, isn't it? The other thing is that it is a fixed percentage, the dividend payment. So that fixed percentage could be in your favor or not, isn't it? I suppose depends what you're able to negotiate. You don't have to pay dividends, that's a plus. You have to pay to pref first, that's a minus, I suppose. What about cash flows? You have to redeem it, right? Yeah. So we have cash flow implications, right? We have cash flow implications of a cumulative dividend that accumulates and you have to pay it, maybe eventually, and redeem. Yeah, I don't know what the term is. That's a good question. The term. Long term, would be good. If it's more medium term, not so good, isn't it? Do you agree? We'd have to look at the term of those cumulative redeemable preference shares. I think you must say at some point that I said you have fixed percentage dividend paid. It's actually interest because it's a cumulative pref-div, isn't it? And there's only one. There's one thing. It is actually interest, but the problem is that it's not tax deductible because there's no tax deduction on dividends, isn't it? You have to pay tax first and then pay dividends. So there's no tax deduction on dividends. Anybody have anything else that they said? Anything else you guys here said? No?
If they don't want to issue the dividend in the first year, they can actually take their proportional profits if they don't have enough and actually invest in something else to earn.
Correct, yes. So there is this one where I said, and I put a tick, isn't it? They don't have to pay dividends. But then the ordinary shareholders must be aware of the reason maybe why dividends aren't being paid, which is to save the dividend that would have been paid to preference shareholders. And you then have the implication that if those preference shareholders, if you need money from them again in future, they're not going to want to invest. Yeah. Sometimes when your dividend is overdue, there's a thing that kicks in, which is that you get a vote. Have you heard of that? If there's an overdue dividend, an arrear dividend on a cumulative pref, those preference shares become voting shares. So it gives them like a right to, in an AGM, complain, about the way they're being treated. Yes. Oh, I don't know. It's probably quite a process, But these preference shareholders, remember, have no vote. Say they don't vote. They're not ordinary shareholders. Yeah, so in fact, some of the things we said in one, like we said, there's a loss of control, isn't it? No loss of control because the pref shareholders don't vote. No votes for pref shareholders. The only thing a pref shareholder is preferred for is for the dividend. On liquidation even, they're not preferred. They just get the same share, what's left, the same as ords.
Years that they can roll over this thing.
Well, if it's redeemable, it will just, the accrued dividend, forever. If they choose never to pay a dividend, then they'll never get one.
But the actual shareholder, like she said, would not be happy.
Well, yeah, but there's nothing he can do. Unless he gets a vote, but then it also depends how many of them there are, if their vote actually counts anything, if you look at everybody else's votes. Usually what happens in an AGM, I must tell you, is that even if you're looking at someone and they don't have a big percentage of votes, it happens, I don't know if any of you have been to an AGM, the majority of shareholders are like voters. They don't really care, right? So they don't pitch. Whatever's happening, they're cool with that, and they go with the flow. And then you'll have the few complainers, and they always pitch. And they may not even have a lot of percentage of votes, but because the others don't pitch, when you take the complainers in a meeting, they do have enough votes to carry decisions, isn't it? And often when a company thinks that there's going to be some dissenters or whatever, people that disagree, right? They will try to canvass votes from the others that they think would have agreed, or get proxies from them to try and push things through, because they know the majority of people are okay with it, but they're not bothered to come to the AGM to put their hand up. So they just won't bother to come. But the ones that aren't okay will all be there, isn't it? And then they canvass votes. It's very political. They're fun to go to, these AGMs. There's always one guy. Is he retired? A retired CA. He looks at every cent. It's brilliant. Isn't it brilliant to go? It's just brilliant. It's like theatre. It's brilliant. All right, so we've got lots there, right? Cumulative pref shares. It's not a bad idea, right? It depends how long they are. If they're quite long, if it's like 30 years, 20 years, then 20 years, does start to sound, it is long term, and the solar plant, I don't know, probably after 10 or 20 years will need to be redone or whatever, I don't know. So it doesn't sound bad, this one. It's just that because they're cumulative, we have to pay them, and then it starts to sound like interest, and then it's not tax deductible. I don't think it's the best kind of debt that you can get. What's the third one? The FD. She's a lady, right? The lady FD. She's the cleverest of all of them.
No emotion.
No. So what does the lady FD says? But but she came to. They didn't give her a chance to speak at the meeting. Is that right? It's not that, or did she come unprepared? I don't think so. They didn't give her a chance. The meeting was coming to an end. And what did she say, this lady FD? She said a combination, isn't it, of debt and equity. Debt and equity. Okay, so what do you think of that? It has all the pluses of both, isn't it? So a lot of the things you said in the two do fall in. But it's things like companies should have debt and equity, isn't it? They should have a combination of the two. Yeah. Long-term. Yeah, an optimum combination. Yeah, I'm going to put here optimal. Yeah. Long-term projects, you should be looking at long-term financing, and long-term financing is a combination of debt and equity, isn't it? So those are all the pluses. Debt reduces your cost, it's cheaper, and debt is tax deductible in your business, isn't it? And debt provides leverage in your business, and it can make your return on equity increase. All those things, nice things we said about debt, isn't it? But too much debt gives you risk, and risk means that the cost of equity goes up, isn't it? And that could be bad for your business. So if we look at some of these things, I think like that was good, that was good, that was good, that was bad. What do you think some of the bad things are? Huh? Yeah, liquidity is affected and cash flows. Yeah, we have the same loss of control problems that we had before, isn't it? Except if they maybe use, except if it's a rights issue, or if it's, or retained earnings get used. We have the same loss of control. What else? Yes. So up to optimal debt equity, then you've got the lowest, it's called the lowest WACC, the lowest cost of capital up to that point. If you tip over, then it starts to become bad. The only other thing that I kind of thought is, if you have a project and you have to do 2 forms of finance for the project, it's twice as expensive. And I don't know, but some of you are bankers. It's expensive to raise capital. It's very expensive to raise capital. It's expensive to issue shares, especially a new listing. You have to get auditors, lawyers, sponsor bankers, other merchant bankers, so many people involved doing reports, isn't it? Then shareholders will apply for shares, and their money sort of goes into like trust. Then somebody decides how to issue. It's a whole argy-bargy. But I imagine debt the same, isn't it? It's not a simple process to borrow 16 million rand. So the only thing I thought is twice the cost and time to obtain financing. It's just, if you have to do debt and equity, it's just twice as long, twice as expensive, twice the amount of effort, isn't it, to do it? I don't know, anybody else have any other points? Yes, look, there are quicker ways. Hey, you do a rights issue, that's quicker. Yeah. For some companies, 16 million is not a lot, isn't it? So we're going to talk about dividends later, but there's something called a scrip dividend, which is that instead of giving your dividends cash money, as cash money, you offer shares to your shareholders. So you say, instead of cash, let me give you shares instead of the cash dividend. So issuing shares in that way is quick and easy and not expensive, isn't it? And it allows you to keep their money back in your business, their cash, isn't it? So it's the same as a dividend in essence, really. It's the same. And you get to keep the cash in the business, but you've issued more shares, so it should balance that. You issue more shares, so you've got more shares, so the per share drops, but you've also increased the value because you've kept back cash. So if you look at it, if I give dividends as cash, the value of my assets drops because cash goes out of my business, and I have the same number of shares. If I do it the other way, the cash value, the value is bigger, and the number of shares is bigger, and it should kind of balance if you've done it in the right proportion. Do you agree? I don't know. We're going to talk about dividends later on in the module. All right, so that's this one. Hopefully not next week, because next week we're going to come back and finish assignment 1. But then when we pick up again, we're going to be able to then do the rest of this question. This assignment is only due when? 22nd, in a month. It's also not masses of time, eh? But I will keep an eye on it. This question 1 is all about financing, and then question 2 is all about, there are quite a lot of questions. There are 4 of them. There's one that's an investment question. Question 4 is question 3 is an investment question. Question 4 is also optimal capital structure. So we'll come back and look at that one. So, but you can have a look maybe at the kind of questions they have. The students have been complaining that the exam questions for this module tend to be like things they've never seen. You know, and it's because it's finance, it's practical, isn't it? We teach you principles, and then they sort of can throw it at you in any mix or shape or form, you know. So read your financial newspapers, read MWeb. I used to, when I was working, that was long ago, computers took like 10 minutes to boot up. Do they still take that long? Some of them, eh? 10 minutes to boot up because it's doing all the stuff. Yeah, maybe. And you had time to go get coffee, come back, and page through the newspaper. But they always delivered the newspapers. They don't deliver newspapers anymore, hey? So we all got the... Huh? Yeah, business day. Yes, business day would be there on the desk, on your desk. Somebody would have dropped it off in the morning. And then you switch your computer on, you go get your coffee, and you page through the business day. Once you've done that, then you've booted up. Then you can start working. But it's beneficial because it gives you that time to page through. Yeah. Next week we're going to do mergers. We're going to do assignment 1, finish assignment 1. And we're then going to carry on with the stuff that we started today.